Are you starting to feel pain at the pump again? If so, you're definitely not alone. Rising fuel prices have worked their way into the U.S. supply chain last year, and in 2023, things will be no different. A new Bloomberg report exposes that energy supply shortages are emerging all around the nation, with gasoline and diesel stockpiles still at the lowest levels in a decade. In less than a month, the national average price of a gallon of gasoline rose by over 40 cents, and GasBuddy experts anticipate this increase in fuel prices will double over the next 30 days, sparking even more financial stress for Americans, as well as supply chain disruptions and price volatility in most segments of the industry. Now, we've a lot to cover in this video, but before moving on, we kindly ask you to support our work with a thumbs up and don't forget to subscribe. Thank you. Now, talks of a nationwide shortage of fuels subsided in the past few weeks as oil prices once again took center stage, but the tight supply situation appears to have remained unchanged, and traders are betting on shortages of gasoline and diesel and a new spike in fuel prices. U.S. drivers have experienced a tumultuous few years in regard to fuel outages and price swings. They have seen both ends of the spectrum with gas prices, with prices hitting astonishing lows, with averages below $2 per gallon during the health crisis, and a couple of years later topping out at an average of more than $5 per gallon in June 2022 as demand continued to soar, and the conflict between Russia and Ukraine led to new oil sanctions. But now, one report is warning about fuel shortages all over the country, especially on the East Coast. It also notes that inventories of both gasoline and distillate supplies are reaching dangerously low levels again, with many factors impeding production to keep up with demand this year. On Monday, Bloomberg published an exposé explaining that the European Union's ban against fuel imports made from Russian crude oil takes effect over the next couple of weeks, and the United States will likely see a major impact on its fuel stockpiles, and conditions are going to get extremely dire for East Coast markets. Throughout most of 2022, the East Coast have struggled with lower inventories of gas and distillates while demand remained high. Luckily, a shortage was avoided, but prices soared along with many people's expenses. Now, New York and much of the East Coast are at risk of a gasoline shortage as the European Union's ban of Russian fuel threatens to choke off the backup supplies the U.S. relies on, the report stresses. Although the U.S. is a net exporter of gasoline, most of the supplies are concentrated in the Gulf Coast, and transportation to the East Coast is constrained by insufficient pipeline capacity and the expense of waterborne shipping, it explained. Such market imbalances could trigger a ripple effect across the nation, experts say, particularly because gasoline stockpiles already are at the lowest in about a decade, with inventories in most regions still below the 5-year average for this time of year. To prevent the East Coast and the rest of the country from running out of fuel, suppliers will need to get creative, they added. According to the report, U.S. oil supplies are also very low, contributing to higher prices and making us rely on imported oil to refill our domestic stockpiles. The primary factor in this latest increase in fuel prices is the higher cost of oil, which accounts for more than half of what you pay at the pump, AAA spokesperson Andrew Gross highlighted. In an interview with Newsweek, he also alerted that in a few short weeks, the U.S. gasoline supply can grow tight, and AAA data shows that the same is true for diesel and other distillate fuels, including heating oil. In the first week of January, fuel inventories declined by 1.1 million barrels, and in the second week, they fell by 1.9 million barrels. But during the third and fourth week, distillate inventories dropped by 2.4 million barrels, marking a 17% decline in supply levels in only 1 month. The inventory deficit has grown by 22% or 24 million barrels compared to a year ago, dropping below the prior 10-year seasonal average as reported by the U.S. Energy Information Administration. Stocks at the beginning of January were still the lowest for the time of year since 1951 and the lowest relative to consumption since 1945. It's all about the outlook, says oil price consultant Irina Slav. Diesel and other distillate fuels swung close to a shortage over the past 2 years as demand for freight transport surged amid the pandemic and the lockdowns, but production didn't, the expert outlines. In October and November, a decline in manufacturing activity and freight transport in response to rising fuel prices led to a decline in the demand for those fuels. But even though the lower demand has helped markets not to face a shortage in the fourth quarter of 2022, refineries haven't added new capacity to actually rebuild inventories and prevent that scenario from coming to fruition in 2023. Production remains the big problem, and traders appear to be betting on continued tight supply because of this fact, Slav says. There is simply not enough refining capacity in the United States to ramp up production fast enough to respond to demand levels, she continued. At the same time, gasoline demand is also going through a seasonal slack-off, AAA data revealed in a note released last Tuesday. But that hasn't kept U.S. retail gasoline prices to start soaring again, with the national average rising by 12 cents in the past week and 41 cents in the past month. The national average for regular gas jumped to $3.51 a gallon on Friday, according to AAA. In other words, the national average has climbed by more than 9% since the end of last year, the biggest jump to start a year since 2009, according to Bespoke Investment Group. AAA reports that some states have experienced much bigger gains over the past month, including Colorado, 98 cents, Georgia, 70 cents, Delaware, 62 cents, Ohio, 60 cents, and Florida, 59 cents. But the nation's most expensive markets continue to be Hawaii and California, with averages reaching $4.66 and $4.92, respectively. The national average price of gasoline has risen for the fifth straight week as retailers pass along the rise in wholesale gasoline prices due to continued challenges. Refinery utilization that still hasn't fully recovered from December's cold weather, and it's the refinery maintenance season that's just around the corner, said Patrick DeHaan, head of petroleum analysis at GasBuddy. There appears to be little good news on the gas price front, with prices unlikely to turn around anytime soon. Because of the surge in prices last spring, many refineries that had planned maintenance deferred maintenance until 2023. With the can kicked to this year, we may have similar challenges producing enough refined products to meet demand, especially with the European Union cutting off refined products from Russia starting February 5th. With all that said, industry analysts alert that the average price could hit $4 this year. In fact, in November, DeHaan himself said that the average price for a gallon of gas could be $4.19 in June, in GasBuddy's annual price outlook for 2023. But now, the head of petroleum analysis at the company worries the typical springtime jump in prices will be pulled forward. Instead of $4 a gallon happening in June, it could happen as early as March, DeHaan told CNN. There is more upside risk than downside risk. On top of that, macroeconomic factors have continued to weigh on oil and refined products, as strong demand in China hasn't been slowed much by a surge in new COVID cases. In addition, releases of crude oil from the Strategic Petroleum Reserve have wrapped up. As noted by Reuters market analyst John Kemp, the oil markets are no longer receiving massive injections of emergency oil from the Strategic Petroleum Reserve as U.S. supplies continue to go down. Concerns are increasing that without additional oil, supply will tighten in the weeks ahead, especially as the nation starts to move away from softer demand in the height of winter. Moving forward, it doesn't look good for motorists, with prices likely to continue accelerating, DeHaan warned. Meanwhile, refinery capacity is still being compromised by several disrupting factors. CNN reports that the extreme weather in much of the United States near the end of last year resulted in a series of outages at the refineries that produce the gasoline, jet fuel, and diesel that keep the economy humming. For example, Colorado's sole refinery, the Suncor refinery outside of Denver, was forced to halt operations due to freezing temperatures. When the refinery tried to restart, it suffered a fire and equipment got damaged. Suncor has indicated that the refinery could be offline for weeks. No wonder why gas prices in Colorado have surged by nearly $1 a gallon over the past 30 days. Refineries elsewhere have been sidelined by extreme weather as well. At the moment, U.S. refineries are operating at just 84% of capacity, down from the mid-90% range at the start of December, bespoke data shows. Fuel stockpiles remain very low by historical standards and will come under pressure again quickly if freight volumes accelerate, or refineries are forced to undertake more maintenance, or demands rise faster than expected, Kemp predicts. In such a scenario, shortages would re-emerge quickly, triggering more price hikes and fueling inflation, he wrote. At this point, many farmers from all over the United States are reporting mounting financial challenges in face of rising fuel costs, which can push food prices to new highs. But the unusual wintertime jump in gas prices is drawing eye rolls from American drivers already grappling with high prices at the supermarkets. This is particularly hard for low-income consumers who spend disproportionately a higher percentage of their income on heating oil for their homes in winter months. Now they have to brace for even higher prices at the pump and grocery stores. Gasoline price spikes and suppressed supplies will have a significant impact on all Americans, as well as the U.S. economy as a whole. With limited access to fuel, people are likely to struggle to get to work and school and run necessary errands. This can result in decreased productivity, as many people would be unable to fulfill their daily responsibilities. The transportation sector, which is heavily dependent on fuel, is also likely to be severely impacted. Trucking companies, which deliver essential goods, are expected to face difficulties transporting their products in 2023, which can lead to shortages of food, medical supplies, and other necessities. Freight interruptions can also impact the prices of these goods, making them unaffordable for many families and further exacerbating the economic impact of the fuel shortage. Additionally, for the energy sector, which relies on gasoline and fuel to generate electricity, this outlook is threatening. The shortage of fuel can spark widespread power outages, affecting millions of businesses and households alike. This could result in further job losses and economic instability in the months ahead, given that many companies would be forced to shut down temporarily. Overall, price volatility and shortages may have far-reaching and devastating effects on many sectors of the economy and the daily lives of Americans. The lack of enough fuels could rapidly bring the nation to a standstill because the very fabric of society is built upon the ability to move and transport goods. The cascading effects of the shortages would be felt by every one of us, from the loss of jobs and homes to the shortages of essential goods and services. The economy could be pushed to the brink as businesses struggle to keep their doors open, and the nation itself could be plunged into darkness if the energy sector fails. This is a very dire scenario that we are facing, one that must be averted at all costs.